Hello and welcome to this week's Week in the Markets. I'm delighted to be joined by Matt Henderson, one of our portfolio managers that sits in the investment management firm. Today we're going to talk through the key events that have taken place this week. There's been a lot for investors and markets to digest. We've had economic data come through in the US. We've had central banks meetings in the UK as well as the US, as well as corporate earnings. So a lot to digest. Matt, firstly, how would you characterise the performance that we've seen in markets this week?
Yeah, thanks, Paul. So equity markets this week have been positive, although some of the data that's been released today is starting to challenge that. So that hasn't come through yet for final week pricing. And within fixed income markets, they've been positive this week, just looking at some of the supportive data that's come through and some of the central bank announcements that have followed.
Yep, so certainly a lot for investors to digest. We've seen a divergence in performance in equities and bonds, and more regionally within equities as well. I did kind of start by just highlighting that it has been a very busy weekend, especially for the US market. The US economy, the largest in the world, most important for global investors. I suppose labour markets have been really in focus. We started the week with job vacancies, and we've ended the week with more jobs data. I suppose, Matt, what are the highlights from your perspective?
Yeah, so if we just start where you started that sentence there, Paul, in terms of job openings, we've had the JOLTS data out of the US, so essentially just looking at the number of open opportunities within the labour market from US corporates, and we've actually seen that number increase just over 9 million jobs opened. So from the Federal Reserve's perspective, that's actually quite positive because, more jobs should look to reduce wage inflation, which then ultimately leads through into price inflation in the US economy.
Yeah, so strong data still. I suppose that's important for the US economy. More people employed, more people can earn and spend, and it just keeps the momentum in the US economy, which has been very resilient over the last couple of years and continues to be. I suppose you highlighted wages. We had on Wednesday the Employment Cost Index. Can you talk a little bit around that?
Yeah, so what we've actually started to see, I guess, over the past 6 months with other types of inflation data too, is just that rate of wages starting to moderate. So, in line with what we're seeing, expanding job opportunities, but we're also seeing quit rates start to come down as well. So as we're starting to see the labour market within the US start to normalise, what we would expect to see is actually wages follow, so they start to normalise as well. So that's what we're seeing within wage data, starting to normalise.
And I suppose that sets us up well for what has been the main event within markets this week. Was on Wednesday with the US Central Bank, the Federal Reserve. They had their meeting on interest rates. I suppose coming into the year, there was the expectation that the central bank would start to cut interest rates perhaps as early as March. What did we learn from the Federal Reserve this week?
Yeah, so Fed have kept rates on pause, so currently still within that 5.25 to 5.5 range that they've set. I think, like previously mentioned, some of the data that we're starting to see from inflation, wages, labour market, they're starting to moderate, starting to see the rate of inflation cool on both a headline and core basis. So supportive for the Fed with their dual mandate of inflation and also labour data. So inflation moving back towards 2%. And I guess what that would indicate is that the Fed should start to look at reducing interest rates. But they do have that dual mandate where they're looking at both price or wage or inflation and also labour markets. And, like we've had from this afternoon when we've had the non-farm payrolls come through, strong number, about double what the market was expecting.
Exactly.
So we're continuing to see that resilience within the US economy, continuing to see the labour market remain robust. So the Federal Reserve are a little bit cautious about cutting interest rates too soon, and with the first cut more likely to come in the second half of the year. Just a little bit of concern whether if they cut interest rates too early, whether that then causes inflation to reaccelerate in the second half of the year.
Exactly. Thanks for that, Matt. And then I suppose let's bring it closer to home, back to the UK. Bank of England, interest rates at 5.25%. Any sign of interest rates being cut?
Yeah, so Bank of England, very similar to the Federal Reserve, kept interest rates unchanged, as you said, at 5.25%. And I think what's interesting for us and the investment team to look at is just how the voting members actually did vote within the meeting, and that data is published to the market. So there's 9 voting members. We saw 6 of them say, actually, we should leave interest rates unchanged at the current rate. 2 of those members thought we should actually increase it by 25 basis points up to 5.5%, and 1 member thought actually we should probably reduce it by 25 basis points down to 5.25%, down to 5%. So, you know, still got that divergence within the voting committee. I think they're looking at similar data points as the Fed, looking at wage inflation and services inflation as key indicators in terms of where the economy is going. And they too also see the risk of, if we cut interest rates too soon, do we risk a reacceleration of inflation maybe in the second half of the year?
Exactly, but I think it's important in the projections that they gave that they actually forecast inflation to get to 2%. That's their target by the second quarter of this year, which is instructive and supports the case of lower interest rates, which would help households and mortgages and, of course, corporates and their debt interest payments. Great. So if we now just finish off with thinking about corporate earnings. So these are the results from companies for the financial statements of Q4 of last year. Investors pay a lot of attention to these. They try and get a sense of whether the prices of these stocks are fair value or they're overvalued. In terms of this week, we've had the big US companies report their earnings, so the likes of Meta, Amazon, Apple, come into focus. I suppose, what are the takeaways for us?
Yeah, so these stocks that are of focus to the market, biggest weightings within US equity indices, say like the S&P 500, and we know that they're trading on high valuations, so markets have big expectations for the delivery of growth from these companies. And we've seen some of those companies come through and actually deliver what the market expected in terms of their performance. So the likes of Meta or Facebook and the likes of Amazon have actually come through and delivered good results that the market's happy with, and as a result, markets rewarded that with positive share price performance. Although the one stock that you had mentioned was Apple, and actually Apple had disappointed relative to those other 2 stocks, and it was mainly due to some of the linkages that it has to China. So revenue was down 13% from Chinese sales, so just the continued economic headwinds that China is facing starting to come through in terms of corporate revenues. So Apple was down about 3% in aftermarket following the announcement of those results.
Excellent. Thanks, Matt, and thank you very much for watching. That's all from us today. Have a great weekend, and we'll see you next week.